As people approach retirement, taxes often become a bigger part of the planning conversation. During your working years, taxes may feel mostly like an annual filing event. You gather the documents, you meet with your tax professional, file the return, and then you move on. But in retirement, taxes can affect more than 1 year at a time. They may influence how much income you take from your IRA, when you begin withdrawals, how Social Security is taxed, whether Medicare surcharges may apply, and how assets may eventually pass to surviving spouse or beneficiaries. That is why we believe tax planning deserves a forward-looking conversation. This video is educational only. Montgomery Financial does not provide tax or legal advice. Our role is to help coordinate planning conversations and, when appropriate, work alongside your qualified tax and legal professionals. One helpful way to think about retirement tax planning is through the idea of tax diversification. Many retirees have most of their savings in tax-deferred accounts, such as traditional IRAs and 401ks. Those accounts can be a valuable retirement tool, but withdrawals from traditional IRAs and similar accounts are generally taxable as ordinary income. Roth IRA contributions are not deductible, but qualified Roth IRA distributions may be free from federal tax when IRS requirements are met. So the planning question becomes, do you have flexibility in where your retirement income comes from? If most of your income must come from one tax category, you may have fewer planning options later. Tax diversification aims to create more flexibility by considering how different accounts may be used over time. That brings us to Roth conversions. A Roth conversion generally means moving money from a tax-deferred retirement account, such as a traditional IRA, and into a Roth IRA. The potential benefit is that future qualified Roth IRA distributions may receive different tax treatment than traditional IRA withdrawals. But there is an important trade-off. A Roth conversion is typically a taxable event in the year it occurs, and it may increase your current year taxable income. IRS reporting rules specifically reference conversions from traditional SEP and simple IRAs to Roth IRAs, and the tax reporting can depend on each person's personal facts. That is why Roth conversions should not be viewed as a one-size-fits-all strategy. It should be reviewed carefully. Let's take a look at a hypothetical Roth conversion case study. The purpose of that example is not to suggest what any one person should do. It's meant to show the type of traditional trade-off that can be evaluated. On one side, keeping money in a traditional IRA may defer taxes today, but withdrawals may be taxable later. On the other side, converting a portion to a Roth IRA may create taxes today, but it may change how future withdrawals and beneficiary planning are evaluated. A review can help compare those possibilities using assumptions about income, tax rates, account values, life expectancy, withdrawal needs, and family goals. The key point is not that a Roth conversion is automatically appropriate. The key point is that the decision deserves analysis before action is taken. A Roth conversion review may also connect to other planning topics. For example, required minimum distributions, or RMDs, can affect future taxable income. The IRS describes RMDs as minimum annual withdrawals that generally apply to traditional IRAs and many retirement plan accounts once a person reaches the applicable age. Medicare income-related surcharges may also be affected by income levels. The Social Security Administration describes IRMA as an additional amount tied to income for certain Medicare Part B and Part D beneficiaries. Other areas may include charitable giving strategies, tax gain or tax loss harvesting, estate considerations, and the tax impact of a surviving spouse may face after the death of their partner. These topics are highly individualized. The goal is not to avoid taxes altogether. The goal is to understand the moving pieces and coordinate decisions thoughtfully. So what is a Roth conversion review? At Montgomery Financial, we view it as a planning conversation designed to help answer a few practical questions. Would a conversion create an avoidable tax surprise? Could converting a portion of an IRA fit within a broader retirement income plan? How might a conversation affect Medicare premiums, Social Security taxation, future withdrawals, or a surviving spouse? And should this conversation include your CPA or tax professional before any decision is made? The review is not about pushing one strategy, it's about helping you understand the trade-offs. As you prepare for your first meeting, you do not need to know whether a Roth conversion is right for you. That is what the planning process is designed to explore, and we would get in depth with those planning processes. We will aim to understand your income needs, your retirement accounts, your tax picture, and your goals before discussing whether a Roth conversion review may be a useful strategy. Taxes are only one part of retirement planning, but they can touch many other decisions in other areas. By reviewing them in advance, we believe you can approach retirement decisions with more clarity, better coordination, and a stronger sense of how all the pieces fit together. Thank you for taking a few minutes to watch this before our meeting. We look forward to learning more about your situation and discussing how thoughtful tax planning may support your broader retirement plan.